So good morning everybody, thank you for joining today's webinar. My name is Kate Dobigan and I'm a Chartered Tax Advisor here at the RM2 Partnership. And while strictly speaking we don't give formal tax advice here at RM2, we're always mindful of any potential pitfalls for clients regarding employee share plans. And I'm hoping to highlight some key tax considerations for companies and founder shareholders during this webinar. This talk should hopefully last about 25 minutes or so. So this webinar is going to cover essentially three separate topics regarding employee share plans, which cover corporation tax deductions for companies, readily convertible assets and payroll withholding obligations for employers, and a slightly separate topic, the tax implications for founder shareholders granting options over their own shares. So hopefully I can take you through the issues concerned and, you know, hopefully cut through the detail. So obviously we here at RM2, you know, we work with companies to implement share plans to incentivize employees. That's what we do. That's our bread and butter. And there are obviously a number of tax advantage plans such as the Enterprise Management Incentive Plan or EMI, you know, which we implement for clients, which are designed to deliver value to employees at a tax rate ideally of 10%. But we as advisors, you know, tend not to focus on the benefits of an employee share plan for employers. And namely, that's the types of deductions that a company can make in relation to its employee share plans. And there are three different deductions that a company can potentially make that I just wanted to bring to your attention. So the main one and the most valuable one is a statutory deduction that can be made by the employing company in the accounting period at the time of a taxable event for an employee taking part in a share plan. And they're also something that you may be more familiar with, where companies can make a deduction under general principles like any trading expense. And then there's another area that's slightly more niche, and it relates to deductions where companies have made contributions to employee benefit trusts or EBTs. It's obviously not relevant for most companies, but again, it's just something I will just touch upon as part of this webinar, just to bring it to your attention, essentially. So as I mentioned, first of all, the most valuable relief for an employing company operating an employee share plan is a deduction which can be made under law, which enables an employing company to deduct from its profits an amount upon which an employee is taxed with regard to employee share incentives. So, you know, that can be quite a significant deduction for employee, you know, companies operating employee share plans. But as with all of these things, there are a number of conditions that, you know, need to be met. And I just wanted to flag them up for you just so that you're aware of the different types of things you need to be thinking about where you know, are thinking of introducing an employee share plan or you are operating one at the moment. So most, you know, obviously an employee needs to acquire shares in a group company. They must be working for a company with a business within the potential to be subject to corporation tax. So that business doesn't necessarily have to be paying corporation tax. It doesn't have to be profitable, but it must, you know, be carrying out a business in the UK that could potentially be taxed here. There are also some conditions around the shares that, you know, just need to be aware of that can cause problems. So they must be ordinary shares. So when we say that, we mean essentially shares that don't have a preference dividend. They must be fully paid up shares and they must not be capable of being redeemed. So lots of different things to think about there, you know, around, you know, what type of business you're operating, the rights of the shares, and also in relation to the employee that's taking part in an employee share plan and are realising a taxable event under that share plan. They must be within the potential charged income tax in relation to their employment. So they don't necessarily have to be fully taxable here, but they have to be carrying out their duties in the UK. Otherwise, there can be some potential for apportionment. But those are just some of the kind of key considerations that you need to be aware of, if you are hoping to make, a CT deduction in relation to employee taxable amounts arising under share plans. And again, I think there are also conditions set out in the law, for companies with share plans, that in order to qualify for that statutory corporation tax deduction, it's quite important that, you analyse the ownership of your company and make sure that you meet the requirements. So the law sets out certain further conditions in relation to the ownership of the company and essentially who owns those shares. So they either need to be shares in a company, listed on a recognised stock exchange, or shares in a company that's not under the control of another company, which is quite a key provision. Or they can be shares in a company under the control of a company listed on a recognised stock exchange, but that doesn't include AIM. So these provisions are quite key at the time of a takeover or change of control. So this is obviously the real main benefit for an employee company with employees taking part in share plans, and that is obviously the statutory corporation tax deduction. And just something that I just wanted to, really flag up for you. And, if you remember anything from this talk, it's that, where you are operating an enterprise management incentive plan, one of the, great benefits for employing companies is that even though there may well not be an income tax liability arising for the employee on exercise, the law specifically says that the employing company is still entitled to a full deduction. So that means there's, essentially no NIC cost to the employing company potentially, but the law says that you can still deduct the full amount. So essentially the market value of the shares on exercise less the exercise price paid. So that obviously can be a really valuable relief, and it's certainly something that is very closely looked at the time of a change of control. But the law does give specific provisions on this basis, and it does say, that even though a tax liability doesn't arise, you can still make that deduction. So that is just something that you really need to be aware of if you are operating an EMI plan at all. And as I've already touched upon briefly, that relief can be lost where those shares are sold and come under the control of an unlisted company. So and obviously you would expect, if your company does go through a transaction, it is something that the advisor should be aware, but just be aware that there is this really valuable relief, particularly in relation to EMI options that are exercised. And if you do have a change of control happening, the law says you've got 90 days for employees to exercise those options and still qualify for the relief. So that is just one of the potential traps, I think, to be aware of in relation to that CT deduction and your employee share plans. Because particularly, where a company doesn't meet the requirements for that statutory corporation tax deduction, what the revenue say is that, well, any taxable amounts, you don't qualify for the CT deduction, unfortunately, and any taxable amounts that arise in relation to, option exercises or the issue of shares to employees, even if you are an unlisted company, those taxable amounts must be subject to payroll withholding. So again, that's just something to be aware of. If you are looking into this area or thinking about taking advice on it, if you don't qualify for the statutory CD deduction and you do have a taxable event in relation to an employee share plan, it's most likely that taxable amount is going to be subject to PAYE and NIC. So again, that's just something that, I wanted to flag up for you just so that you are aware. And actually, and one of the things as well that is important to note, that where you do have a company, such as that, a company under the control of a corporate trustee, as is often the case with employee ownership trust companies, they wouldn't qualify for the corporation tax deduction because they are essentially under the control of another company. So again, any taxable amounts in relation to employee share incentives must go through the payroll. And unfortunately, if you are, owned by an employee ownership trust and you have a corporate trustee there, you know, the chances are you aren't going to qualify for the statutory corporation tax deduction in relation to your employee share plans at the time when options are exercised. So again, it's just, you know, something for you to be aware of where you are operating an employee share plan. So obviously touched upon kind of what the law says, you know, where you meet the certain conditions and you can obviously make this deduction from profits. Where companies qualify for the statutory corporation tax relief, that always takes precedence over any type of deductions that a company can make in relation to its employee share plan. But the law does allow relief for certain other types of expenses that, you know, you may incur in relation to your employee share plan. You know, and it sets out kind of what those expenses are. So, you know, you can make a deduction from profits of expenses kind of setting up the scheme and administering it, any costs of borrowing for the scheme, and indeed kind of any costs in relation to the shares, you know, stamp duty, fees, commission, that type of thing. So even where you do have an event in relation to employee share plan and an employee exercises an option, you can get the statutory corporation tax deduction, but there are other expenses that you can deduct in relation to that plan, but they are limited and they broadly fall into those three categories on the screen. So again, that's just something to be aware of. And as like any other expense that a business, you know, deducts from its profits, they've always got to be incurred wholly and exclusively for the purposes of the trade, which I'm sure is something you're familiar with. And again, they have to be revenue costs and not capital costs. So it can be tricky trying to determine, you know, exactly what costs you can deduct in relation to that employee share plan. So, I mean, I think the implementation, chances are you're not going to be able to deduct the full cost of that, because ultimately you're implementing a scheme and it's going to have an enduring benefit. It's going to be there for a number of years. But, you know, where you are taking advice on what is the most appropriate scheme, that I think looks like a revenue expense. So you probably could deduct that as an expense, you know, from your profits. And again, you know, all expenses must be, you know, recorded in your accounts in accordance with generally accepted accounting practice. So again, probably all points you've seen before in relation to your business, but, you know, just something to be aware of, that there may be other expenses you can deduct, you know, in your accounts and get relief for. So I think the most obvious example in relation to an employee share plan where you make a deduction under general principles, that's kind of something like employees NIC. That's obviously a deduction that you could make from your profits. So I think that's, you know, quite a good example of a deduction that you could make under general principles. And just moving on to the third type of deduction that you would see companies making in relation to employee share plans. Obviously a slightly more niche area, because not all companies operate an employee benefit trust. But again, just for completeness, just to bring it to your attention, you know, with this type of contribution to an employee benefit trust, or EBT, just to be aware that any amounts that are paid to that trust are likely to be restricted. And as I mentioned before, a statutory corporation tax deduction on exercise will always take priority over any other types of deductions. Where it's not available, in the case of a contribution to an employee benefit trust, perhaps because you've got cash in the trust and you've decided that you're just going to bonus it out to employees, you can only make a deduction under general principles in relation to that employee benefit trust where qualifying benefits are paid out of the EBT. So what does that mean? Well, basically you need to pay out a cash bonus to your employee and they need to be subject to income tax and NICs before any deduction can be made from your profits in relation to that contribution to your employee benefit trust. So if you are operating an EBT, you know, and you've not taken advice on it yet, it's just something to be aware of, that there is most likely to be a deferral of any type of relief until funds are paid out to employees and they're subject to PAYE NIC on them. So again, just something to bring to your attention, essentially. So we kind of talked through what are the benefits for a company operating an employee share plan, and what those deductions look like, and what it means for an employing company. But there is another area that we do have lots of questions from clients regarding, and it's something that's it's quite a grey area, and that is the matter of what are an employing company's payroll withholding obligations where it is operating an employee share plan. So to recap, the taxable amount on issue of shares to an employee is subject to payroll withholding where those shares are considered to be readily convertible into cash. So as you would expect, if you've got a listed company where an employee can exercise their options and readily sell them on the market, the revenues say, well, this amount is taxable, those shares are readily convertible into cash, so there's a clear payroll withholding obligation for that employing company. And that's also the case for unlisted companies, who don't have a market in their shares, but where they're operating an internal share market, and there's a clear understanding from those employees, the revenue would say again, well, there's a clear payroll obligation there at the time of a taxable event for the employee. But for most RM2 clients, it is a grey area, because most of our clients are unlisted and don't operate an internal share market. So it isn't necessarily always clear what those payroll withholding obligations are. And the law is quite woolly, and it essentially says assets for which trading arrangements exist or are likely to come into existence will be treated as readily convertible assets and subject to payroll withholding. And a taxable amount would need to go through payroll in that instance. So what do we mean essentially when we say trading arrangements? So shares in an unlisted company without an internal market become readily convertible assets where trading arrangements arise. So if at the time of a taxable event in relation to an employee share plan, arrangements exist that enable that employee to realise an amount not less than the current value of the shares, or such arrangements are likely to come into existence at the time when, say, the employee exercises their options, that can create a payroll obligation. So I think the most notable example to be aware of is obviously at the time of a sale of the company. So a payroll obligation can arise for unlisted companies where they have taken meaningful steps towards a sale for cash, and an employee exercises an option and is aware that that is the case. So they're aware that arrangements are likely to come into existence. So it is quite a grey area. It isn't clear, but I think those are the types of issues that you need to be aware of if you are an unlisted company operating an employee share plan. So I think the key event to be aware of is there a sale in prospect? Are you a fair way down the line? Are employees aware of that potential sale? And if so, you may well be creating a requirement for any taxable amounts to go through payroll where employees are exercising options or being issued with shares. So again, it's one of those things, speak to your advisor, but just if it's not something you've come across before, to just be aware of, where you are working to or looking at an exit, it can have payroll withholding obligations for your employee share plan. And just on a separate note, just whilst we're on the matter of payroll withholding obligations arising in relation to employee share plans, where that withholding obligation does arise in relation to employment-related shares, so shares essentially held by the employee, there's quite an unusual law that says the employee must make good that PAYE to their employer within 90 days of the end of the tax year in which the taxable event takes place, Otherwise, a tax on tax charge can arise. And again, speak to your advisor about it, or speak to us. But it's just something I just wanted to flag up for you. If you think you do have a payroll withholding obligation in relation to your employee share plans, there is a potential risk for a tax on tax charge to arise. So that's, again, just something to be aware of, essentially. So just moving on to kind of look at readily convertible assets. And I think we've touched upon some of these already, but some assets are deemed to be readily convertible. So even if you are an unlisted company and you don't operate an internal share market, there's just a list there up on the screen that kind of says, if your employee has a taxable event in relation to one of these assets, then, and even if there's no trading arrangements in place, the taxable amount is going to have to go through the payroll. So the first one's obviously not relevant for most of our clients, but an interest in a partnership. Shares that aren't ordinary share capital, so shares that have preference dividends, shares that aren't fully paid up, shares that are redeemable, and again, shares in a company that is under the control of a company that's not listed on a recognised stock exchange. So I think that's something that we touched on earlier, where you don't meet those requirements for that statutory corporation taxation. Obviously, it's a deemed readily convertible asset, and any taxable amount must go through the payroll. And again, shares in a company in relation to taxpayers, not the employing company or the parent of the employing company. Probably quite an obscure rule, but again, this is just a list. So just to bring to your attention, just to be aware that, where employees are acquiring these assets and a tax liability arises, they must go through payroll. But, essentially, where you are an unlisted company, you don't have an internal market, there's no understanding that employees can sell their shares for cash. And your shares, you're comfortable that your shares aren't readily convertible assets, then so just to be aware that obviously the taxable event must be disclosed by the employee on their tax return and the income tax paid via self-assessment. So in that instance, there shouldn't be any NIC cost to the employing company. So I think this should be the default position for most RM2 clients who are unlisted, who are operating share plans. But where you do have an employee with a taxable event in relation to a share that doesn't need to go through payroll, it's always recommended that they take personal tax advice just to make sure that they're fully compliant with the law and settle their liability. So we've obviously touched upon what deductions a company can make when it's operating a share plan, and some of the things you need to be thinking about with regards to payroll withholding obligations. A third quite separate issue that I just wanted to touch upon just before we finish, and it's something that clients often raise with us that they think's quite a simple solution to a problem that they have, and that's regarding who should be the grantor of an option under an employee share plan. And from our perspective as advisors, the ideal scenario would always be a company to grant an option over unissued shares. And just to touch upon why that is our ideal scenario. Obviously, there's no stamp duty for the UK company when it issues the new shares, and there should be no tax charges for existing shareholders in the company on exercise of the option. But some clients do come to us and say, well, obviously, if we grant option over unissued shares, then everybody, all shareholders will be diluted when employees come to exercise those options, and that's a problem. So surely a solution is to just grant an option over one or two founder shareholder shares, and surely that's fine. And again, just to talk you through what the different issues are, that does create a number of tax problems, mainly for the founder shareholder, and it really isn't a kind of simple solution. So again, just to take you through the different things that you would need to think about if it's something that, if you're considering putting an employee share plan in or making further grants. Where a founder shareholder grants options over his own shares, this can create a capital gain for him and create a capital gains tax liability. And obviously the employee holding the option is likely to have control over when they exercise that option. So the founder shareholder's got no control over when that capital gains tax liability might arise. The The revenue accept that a capital gains tax or CGT liability shouldn't arise on grant, but there is likely to be a chargeable gain for the founder shareholder with an option over his shares when the employee comes to exercise that option. And again, without hopefully being too technical, again, if it's something that you are considering or looking into, it's important to note that the option agreement must clearly bind that founder shareholder to transfer the shares to the employee on exercise. And the reason why that is to ensure that, you know, we qualify for a provision in the law that says where the founder shareholder is bound to transfer the shares on exercise, they should only be subject to capital gains tax on the exercise price that they receive, less any costs that they incurred for the shares. So they're going to be taxed on the exercise price they receive rather than the market value of the shares. So, you know, that is your risk. Also, you know, where an option is granted by the company, but then later settled by founder shareholder, I mean, strictly speaking, the law says they should be taxed on the market value of the shares at the time, which is likely to be higher than the exercise price, you know, rather than the exercise price received. So, I mean, again, the revenue have said that they won't take this point, but it's just to bring it to your attention, it's not a simple solution. It creates a capital gains tax liability for the person granting the option over their own shares. And there is a risk if certain procedures are not followed that they could end up with a hefty CGT, you know, liability, which is obviously less than ideal. There's also quite a risk of a PAYE and NIC charge where a founder shareholder grants an option over his own shares to an employee. And, you know, just to summarise, if it's something you've not come across before, disguised remuneration, it's a series of anti-avoidance provisions which can result in charges to PAYE NIC for an employee where a third person other than the company in the employing group essentially earmarks, you know, amongst other events, shares for the benefit of an employee. So there is a risk of a PAYE and NIC charge where someone other than a company in the employing group grants an option to an employee. And that's obviously a PAYE and employee NIC charge to the employee, and also an employer's NIC charge for the employer. And, you know, whilst this legislation was introduced to target employee benefit trusts, you know, to prevent them making loans to employees that weren't taxable, there is a risk, as I say, where that founder shareholder grants that option, that you could be creating a PAYE and NIC charge. And, you know, and whilst there are, you know, a number of exemptions in the lengthy legislation, you know, that should exempt a PAYE NIC charge from arising, you know, when the founder shareholder essentially earmarks the shares, which is the case, you know, where a founder shareholder grants a qualifying EMI option with an exercise price equal to market value. The law is complex and advice should be taken. I mean, and I think our advice would always be, ideally, the company should grant the option to remove this risk, because the legislation on, you know, third parties taking events in relation to employee options and benefits is horrendous. So it's best avoided, in our opinion. And again, just to touch on another couple of other tax considerations that founder shareholders should be aware of, you know, if they do decide to go down the route of granting options to employees over their own shares, it shouldn't have any implications for that statutory corporation tax deduction that we've talked about before. The law doesn't care who grants the option, you know, so that shouldn't be an issue, you know, assuming that all of the other criteria are met in relation to the option. And just, you know, just separately, again, something to be aware of, if I haven't put you off a founder shareholder granting an option over his shares, there are kind of inheritance tax or IHT considerations to just be aware of. You know, technically speaking, that there is a risk that, you know, there's a transfer of value on grant of the option. You know, I think most advisors would argue that there isn't any gratuitous benefit, but there does remain a risk. And you know, where there's a risk, you know, we would always say take the least risky option. But that's the only kind of risk in relation to inheritance tax for the founder shareholder. There shouldn't be any further inheritance tax considerations on exercise or anything like that. But I think it's, again, just something to be aware of, if it is something that you are looking into. So I think just to summarise, essentially, kind of some of the subjects I've touched upon in this webinar. Always take formal advice. Speak to your share scheme advisor, or or seek out an appropriate advisor to kind of take you through if any of these issues are relevant to your business. And I think, to summarise, on the matter of a statutory corporation tax deduction, it can be a very valuable relief. Particularly where enterprise and management incentive options are concerned, and it can result in a price reduction at the time of a company sale where those conditions aren't met. It can be valuable. For some companies, it can be worth millions of pounds. So there is some benefit there in, ensuring that your company will qualify, and that you don't fall foul of one of the traps, in relation to who owns the shares, that type of thing. And again, with regard to payroll withholding obligations, you need to be clear at the outset when you implement your employee share plan, what the requirements are in relation to it, and just to be comfortable that you aren't going to trigger any penalty or interest charges for a failure to operate PAYE correctly. If you are an unlisted company, the main one to be aware of is if you are, in negotiations for a sale, and you have some exercises coming up, and they are taxable. And again, I think on the matter of which party should grant an option, our strong recommendation is that it's always simpler and cleaner for the company to do so. There's significantly less tax risk for the founder shareholders, and it's just something that we would always encourage our clients to do. But sometimes it does depend on the company, doesn't it? And what their commercial requirements are with regards to dilution. So that's kind of everything that I wanted to talk about, really. Lots of detail in there. Hopefully it's not been too boring or complicated. So thank you for your time. I'm happy to answer any questions that you may have. My contact details are up on the screen at the moment, if you want to speak to me directly. And thank you for dialing in.